This content is general in nature and should not be considered financial advice. Please listen to the full disclaimer at the end of our podcast. Hello, ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today, we have a very special guest, our partner from Westbridge, Marc Giuffrida. Welcome aboard.
Thanks for having me, Theo.
So, just to give a bit more colour and context on when I say our partner from Westbridge. So Westbridge is a partner in our syndication business, Shore Invest. Hopefully most people know by now that we have launched a commercial asset syndication business under Shore Invest, and we have multiple partners in that business. Our first transaction and partnership was in 2024 with Wingate, and then last year we successfully settled a transaction with our new partner, Westbridge. So today I wanted to take the opportunity to talk through a little bit more about commercial syndication. And whilst we've spoken about it briefly back in 2024 in a podcast with Wingate, I thought it'd be good to get our new partner, Westbridge, on board and talk about a bit about what Westbridge does, and also, I guess, just showcase that great asset that we syndicated together. And to give more context to our listeners and our customers and clients and whatnot, we get pitched a lot of assets to syndicate, as Marc would definitely appreciate. Our ability to raise capital is now somewhat circulating in the asset manager ecosystem, and so we get a lot of people sort of call us up and pitch us assets, but we really take our time to find, firstly, a good asset manager, a reputable asset manager, and one that we can trust with both our own and our clients' money. And two, the right opportunity, right? There's some good asset managers out there with the wrong opportunities. So last year, we found both those things with Marc and Westbridge. So why don't we firstly talk a bit about you and Westbridge, Marc? Tell me a bit about, Westbridge as a business and an asset manager.
Yeah, so Westbridge, headquartered in Perth, has been running in various guises for the last 25 years. Moved into funds management through acquiring a Perth fund manager for about 10 years ago, just a little over 10 years ago. And we've quietly grown that business to about $1 billion in funds under management. But more importantly, we've been focused around moving that portfolio more towards the East Coast. So about 50% of our assets sitting on the East Coast, about 56 assets.
When you say $1 billion in funds under management, that's $1 billion worth of commercial assets.
Yeah, commercial assets.
Commercial properties under management. And just to debunk some of the jargon, obviously when we refer to an asset, we're referring to a commercial property, but when it's institutional grade properties like this, they're referred to as assets.
Yeah, sure. And about half of that sitting in industrial real estate, about 30% of that sitting in retail, value-orientated retail, so shopping centres and large format retail. And then we've been moving rapidly into medical, which we like, and we've got a couple of little office assets in there, but not many.
So that's one thing that we loved about Westbridge is the diversification of assets under management, properties under management, that is. A lot of fund managers or asset managers sort of target one category, especially the more boutique operators, which are the ones that we like to partner with. A lot of them either stick to retail or stick to office, but you've got a diverse sort of portfolio and experience in all those sectors.
Yeah. We've got to be, being value-orientated investors, you need to be across multiple buckets, but still have the expertise to get deep once you find where you can see value. So we like to see, we're getting about 1,000 deals a year that we're sort of filtering through across, all the different asset classes. And if we can start to see, like, for example, and we'll talk about it a little later, like medical, if we start to see an opportunity into that, then we've got to get really specialised and get very deep into that sector.
Well, it sounds like you've got the same philosophy to your investors and your clients as we do, where, you want to be able to offer them exposure to different sectors in asset classes. If you're just pushing, one particular sector, then, naturally they're going to have to look at diversification in other ways, right? So showing that you're interested in all opportunities. And sometimes, the yield isn't necessarily all it comes down to. For example, correct me if I'm wrong, offices are probably the highest yield, but that's because it's directly correlated to risk, and it's the highest risk.
Yeah.
Sometimes you can chase things like industrial with much tighter yields, or depends on the asset, but that's for a reason.
Yeah, more growth. And we're always looking, when we're looking at value, we're also looking at what's the catalyst that's going to sort of drive some growth in there as well. So you're right, it's not just about yield, but what's going to help change that asset into the future, give us sort of growth at both the income level, most importantly, but also at the asset level to make that a more valuable asset into the future. So looking at catalysts for that, and you hit the nail on the head with office at the moment. Maybe it's becoming less difficult, but it is a difficult sector at the moment. But that's why we've found success in industrial, which has been off the back of e-commerce and changing supply chains off the back of COVID, which is still running through the economy.
Yeah.
Retail, we're still consuming.
Yeah.
We are still going to the shops, and we like the medical space because we're getting older and we need more services from the medical sector.
Yeah, medical's that sort of recession-proof type sector. Retail, also quite, probably second to that, recession-proof in the sense that if the retail businesses are taking a margin of spend, but they're essential sort of businesses like a grocer and whatnot.
Yeah.
With inflation, that margin just improves.
Yeah, absolutely.
So, and speaking about office, I think when we first sort of caught up early last year, it was quiet. Yeah, I'd say the first quarter of last year, there wasn't that many syndicates floating around. And so for the listeners that don't understand what I'm referring to in a syndicate is just a pool of investors that come together to buy these assets in a trust. Sometimes they could be a single asset fund, or sometimes it can be a pool of assets in the unit trust. I believe Westbridge offers both those type of products. We like to stick to the single asset fund so that our investors have a tangible percentage, or they feel like they have a direct ownership in that property or that asset.
And also can segregate what their exposures are.
That's
on. The other element. So
they can choose what they're investing in or not.
Yeah. And choice is a key thing. And a lot of our investors are in 4 or more products with us, which is quite unique. And part of that is because they might say, I don't like East Coast retail, but I like East Coast medical. I like living and residential in Western Australia. I want logistics in Brisbane. And so we've been able to offer that.
So
their views.
That was a bit of a segue from where I was going to in the office space. So the start of last year, not many syndicates floating around, not many deals that were being sort of put together with private investors. However, then come around May, June, all of a sudden there was 10, 15 at least sort of decent opportunities, some of them floating around, but predominantly in the office space. And we saw yields between 7 to 9.5, even maybe 10%. But a lot of them were associated with I guess that changing climate in office. So to further give colour on what you were talking about, we had the working from home adjustments in COVID where a lot of businesses downsize their spaces. So for being a landlord in an office building was quite complex as you had, large vacancies and whatnot. And now we've got this new era of AI sort of potentially making businesses downsize even further. So office was definitely priced to risk. And, we were discussing looking for an appropriate asset. And then toward the tail end of last year, we found a great medical asset together. Or I won't say we, I have to give you the credit for that one. That was all you. So why don't we dive into that? College Junction Medical. So this was an asset that we released to our investors, when was it? Around October. Yep. And we settled on it just at the end of last year in December, just before Christmas. So it was a quick turnaround, maybe not as quick for you as you were doing your DD before that. But why don't we talk about that asset, what Westbridge liked about it, and the opportunity it presented as an asset to investors?
Yeah, so let's start with how we got into medical in the first place in the sector, because College Junction was actually our fourth acquisition, and hopefully in the next couple of months we'll have a fifth one coming into the fund as well.
Fifth medical asset in the fund, yeah.
I mean, at the start of 2025, we just acquired some retail and logistics. We wanted to buy more of that. But back to you sort of talking about lots of activity in the sector, you were talking about office, but equally in retail, you had a lot of retail assets. And what we found is we went from sort of being at the front of the pack buying things to not even getting callbacks. And we were just trying to look for where we could find some better yield, get to the front of the queue. We couldn't find that so much in retail. It was becoming still quite competitive in the industrial space. And then we discovered that there was a lot of medical assets on the market, and we were getting a lot of inbound phone calls to sort of say, hey, look, would you look at these things? Because we'd actually had in our past lives and in various funds some exposure into medical assets. So we knew a little bit about the space. So back to that value orientation of how we look at things. So we had that set. We thought there was an opportunity here. The yields looked attractive compared particularly to those other asset classes. And then we started getting, quite deep into the sector, and that's when we started to realise that it's got really supportive demographics. Sort of the ageing population goes from I think 20% to 30% over the next 30 or 40 years.
So to call out this area, we're talking Clayfield in Brisbane, which is 6 kilometres from
Brisbane CBD.
Brisbane?
Yep.
You talk about the demographics of Clayfield, or you talk about the demographics in general?
In general of Australia.
Okay.
Sorry.
Yeah.
And then that means more doctor visits. There's more procedures. There's more analytics that go on around all of that. So the role of the doctor plays within people's lives moving forward is going to be greater and greater. And so we just felt that medical centres are almost like the new retail in some ways. It's like a service-based retail. It's everyday demand from people. They're going to be needing more and more of medical services in their lives. And in fact, I think the spend in medical is running at around 5% per annum versus the economy, which is running at around sort of sub 3 at the moment. So you could start to see that. Pricing was adjusting in the sector. Yields were looking at attractive. We've got the growth. Now we've just got to find the assets. So Clayfield we loved because we had an institutional grade asset built 2017. All secured, 50% of the income being secured by one of the larger radiology groups in Australia. And then there was a built-on ecosystem of GPs, other eye clinics, mental health, cosmetics around that.
I want to slow that down a little bit, Mark, because you're talking a lot of asset manager jargon that I want to break that down for our investors. So, Clayfield being the location of the College Junction medical asset that we syndicated together. When you refer to 50% income secured, you're referring to the predominant tenant, the anchor tenant, who was that Qscan, a nationwide radiology business that at one point was PE backed by Quadrant. I think Quadrant sold their interest to a New Zealand fund
Infratel, I think it is,
for like $900 million or something like that. Or the whole business, I think, sold for that price. So a very strong, buoyant anchor tenant that represented over half the overall rental revenue. So that gives strength to the revenue long term. Yeah. They had a 7-year lease, I believe.
Yeah.
With about, was it 5 or 6 years to go? No, 7 years to go.
Yeah.
And then the other mix of tenants, forgive my memory here, but I think there was about 7 other tenants.
Yeah. Oh, if you take Qscan out, 6 other tenants.
6 other tenants, excluding Qscan. So the tenant mix, all sort of supportive of sustainable earnings as such, is what you're alluding to.
Absolutely.
Yep.
And acquired at a price which gave us quite an attractive yield for doing that, and being able to work within the time frame that we were talking about before. So I think from October, I think we sort of had to have everything sort of done before Christmas, so we had to marshal and move very, very quickly.
And I just want to probably highlight and reference that tenant mix and that asset in comparison to what some of our clients and investors purchase personally, right? So some of our investors might have put in, let's say, $400,000 or $500,000, and those type of investors might have put that same amount of capital to, let's say, a residential investment for $2 million or something like that. Or if they wanted commercial, maybe a commercial investment probably for less than that, given the low LVR requirements of maybe 1.5. Now, naturally, in both those situations, they would be buying something that's probably single tenanted. Even the $1.5 million commercial asset probably has one tenant. And so and in a residential property, you've got a tenant with a 12-month lease normally. In the exposure that our clients get to sort of pulling funds together and purchasing assets like that, you get a pool of tenants. So even if one tenant, has a insolvency issue and you lose a portion of that income, it'd be a stretch for that to be the anchor tenant who's the $1 billion business thereabouts. It'd be one of the smaller tenants that probably represent about 4 or 5% of revenue, right? Yeah. On top of that, like we just alluded to, you've got businesses that have between 4 to 7 year leases, as opposed to these 12-month leases in residential, or in a smaller individually owned commercial asset, probably
3 years.
2 to 3 years. Yeah. So really low risk, great exposure, and high yield. Now that's a great segue. Yield. Most of these assets that our clients look at purchasing on their own are, and residential, they're targeting, 4% attractive gross yield.
Yeah.
Keyword gross, right? Same as commercial, maybe 5-6% in these areas that are similar to Cladeville, right? In capital city locations.
In a band.
Yeah, not regional areas. Yeah. Sure, you can purchase something in Bundaberg and maybe get 10% or something like that. What was so attractive about College Junction Medical was the net passing yield of 7.47%, I believe.
Yeah.
Which is very high for medical, right? Typically, historically.
Yeah. And that's absolutely what attracted us to that opportunity. And then what you also didn't mention in that one is that with those longer leases is inbuilt fixed increases along the way.
Yeah.
So that's an added bonus within there as well.
And to expand on that, to give our listeners more colour, typically, once again, comparing to residential investment, you have to negotiate an increase with your tenant on an annual basis. With commercial leases like this, there is a fixed percentage increase negotiated or already fixed pre-agreed into the leases from the moment they take it. Typically, on that asset, it was around 3.5%, some maybe 4%. So every year, a fixed increase of 3.5% to 4% gets applied to the rent, and you don't need to get into negotiations with each tenant on an annual basis.
Yeah, that's right. And so, look, just trying to keep things simple. Life can get, and some investments can get incredibly complex. We just want to try and keep everything simple. It's easy to understand. You do a great job of explaining all of that. Sometimes we do get lost in the jargon, but once you sort of put the thesaurus in there, it is, we just try to find really good assets in great catchments, supported by markets that have got, good growth prospects. And that gives us the chance, improves our chances of being able to deliver good returns. And within the medical space, we were looking at that when most people were looking at, back to the office sector. We were looking back at retail, which is sort of going through a bit of a renaissance. And so we had this, I wouldn't say it's totally uncontested, but fewer competitors. And that gives us a chance to be able to buy better. And that flows in. That's the great starting point for any investment, is being bought well, right?
So to call out a bit more about this asset as a high-level summary. So it was a 30 mil acquisition where we raised 16.4, which we did 50-50 between Westbridge and Shore. That net passing yield of 7.47% naturally is on that purchase price. In a different climate, that could have been different, as people would have in a different climate paid more than the 30 million. The previous acquisition price about 5 years earlier was about $6.5 million higher than that. And it's a testament also to the previous owner of the asset is a testament to the the attractiveness of the asset. It was an institution that owned the asset, a publicly listed institution, which showed that this is a grade commercial grade asset that institutions are attracted to. Now, I guess the add value opportunity. There's some parts of the asset which we can, I guess, reposition or capture in growth over the 5-year term. So, once again, for the investors that don't know what we're referring to, this was a 5-year investment term. So, the asset was settled and syndicated last year in December, and the aim is to divest and sell the asset in 5 years' time. We had a targeted IRR of 13?
13-ish.
Yeah, 13%. So that's with the capital growth and distribution combined. Investors got a monthly distribution of 7% paid along the way. And the capital growth is obviously then recognised at the end when the asset is sold and investors get their capital back. The add value, the repositioning, the unloved element, that you guys look for. This one, we won't say it was unloved because it was a fairly new built in 2017, like you rightly called out. But there is some capital appreciation opportunity, just like our last asset with Wingate. What we liked about this one was that the previous developer who built the asset back in 2017 actually had a DA to go up a whole extra floor. And there's potential, there's scope. Won't say there's I should say there's an opportunity to potentially lease that to one of the existing tenants who might need the extra space, or just find a new tenant. But more importantly, the building has been purpose built for that extra level. So the elevator goes actually up to that roof space, and the concrete, the formwork, the engineering is purpose built to allow a whole extra floor above.
Yeah, so we've got to investigate that, and that certainly comes into our thinking. We see that more as a free option into the future, and that's what we always look for in all those assets. So, what else can we get out of these? And just to deviate slightly, like we're looking at a lot of industrial assets where we can, which are land rich. So we've got small buildings on, a lot of area, which we don't necessarily have to pay additional cost for, but we can see how we can expand that facility elsewhere. With regards to Clayfield, we're looking at, being able to add to the top level on that over time, and certainly investigate that. And whether we do that or not, whether the economics sort of serve us there or not, it's an option that we can always sell on to the next buyer. So it's always nice to have that option. Rather, you want to have other levers that you can be able to drive,
which I believe increases the lettable floor area by 26% if you did expand into that roof space. And just to give colour on those levers, I don't want to promise anything to our listeners, but the avenues that we're exploring that were discussed with our investors at the time of acquisition were potentially cash flowing that in the future and maybe 3-4 years down the track, using the funds in the trust. So, as in, if we added that extra space to one of the existing tenants, it's not like the investors need to come up with capital to then build that extra roof space. We could cash flow that with both a increased valuation and the residual funds that have accrued in the trust. Or alternatively, if that whole exercise becomes too hard and the numbers don't stack in terms of raising the money or the bank valuation, then alternatively, you can just sell that opportunity to the future investor in 5 years' time.
Exactly right. But you want to have the ingredients there on the table to be able to sort of put it all together for someone. And that's what we've got there. And so we'll work through our other plans. You don't get returns for degree of difficulty. So sometimes the easier pathway is the best, and that's looking after good tenants and extending their leases out for longer. But being able to make that, being able to allow tenants to grow into additional space and have that space for them to be able to grow into is definitely a benefit.
And the other ingredients, I guess, for a future purchaser, because when purchasing these assets, you always need to look at exiting at the same time, especially when 5 years is actually, a lot of our investors sometimes say, "Oh, do I want to, part ways with these funds for 5 years?" But 5 years is not that long of a period of time in the world of investing. And so when you're making the decision of acquisition, you also need to at the same time think about divesting the asset and how, what's going to be the appeal on sale to a future purchaser. And the appeal here is, strong, stable income with also potentially, if we don't do it ourselves, an opportunity for development upside.
And we're always looking for something that can be future-proofed, right? So always focused on who's this going to be attractive to into the future.
Mm.
And if you've got modern, well-connected facilities in growth areas or in strong areas, which is difficult to add supply. I know you've been up around there. It's very difficult to add additional supply into that space. You sort of, again, back yourself and realise you've got the elements to be able to have a really attractive asset which can't be competed away anytime soon. And so we're pretty confident and have a high level of conviction that that'll serve the next owner in the future quite well.
Mm-hmm.
Don't know who that is.
So I guess
have the right asset.
So talking more about the numbers on the asset. So like I said, 30 mil acquisition price, 16.4 million raised, and then a debt facility of around 55% LVR. The difference in that is obviously a cost associated with purchasing, and we leave some funds in the trust account from day one. I think it's about 500,000 from day one, which may sort of increase or accrue to a more significant balance if rates come down and whatnot. I did like the fancy modelling that you did with all those different scenarios. I think we need to call out another question that we had from our investors was around how the debt facility actually worked. And it's important to call that out. So that 55% debt facility, what was the actual loan amount on that?
Of dollars?
Yeah, it's probably about 18-ish
million.
Yeah, 18 million. I think all up, the interest rate was about 4.8.
Yeah.
So we say all up because it's a floating margin above it's a fixed margin above BMW, the bank bill swap rate. So that's very sharp for our investors. Personally, our residential investors are looking at 5.5 for 5.6 for interest only facility for investing. Same as commercial, it's probably even higher than that. Depends the asset and depends the risk. So you're getting exposure to cheap funding, and more importantly, the part that our clients or investors were asking about is that your capital still gets the benefit of leverage. So what I mean by that, if you were putting in, $400,000-$500,000, then you're getting, $800,000-$900,000 worth of exposure to that asset. Yeah. So you own, $800,000 to $900,000 of the asset if you're putting in that $400,000-$500,000 because that 55% LVR is, your capital's getting the benefit of that debt position. The beauty of that debt position, though, is that none of the investors are signing personal guarantees to service it.
That's right.
So it's in its own separate unit trust. So a lot of our clients sometimes either don't have the income to demonstrate serviceability. They might have been tapped out, because they have a portfolio or they've put all their eggs into the basket of the home. Yep. But they have some cash to invest, and they don't want the headache of owning a investor property themselves, or they don't want to have to commit to a significant guarantee of a debt exposure. So it's a great way to invest in property with leverage without having to take personal guarantees and expose yourself to that debt facility.
Yeah, absolutely. And we look at the leverage as being able to get us into higher quality assets that we wouldn't have been able to do otherwise. So, and then Clayfield's a shining example of that.
Yeah. What other call outs should we say? Just talk about the demographics of that area. So we were generalising the whole of Australia in terms of medical being, prime for Australia as a whole. Clayfield, like I already mentioned, 6 kilometres from Brisbane CBD. Brisbane is one of the highest growing populations in Australia. I think it was second or third of the most recent data.
Yeah, and then I think its house pricing is rapidly.
Yeah,
I think it's overtaken Melbourne. I think it hasn't done it now. It will be by the time we go to air.
Well, our last podcast that we did last month with Nicola Powell from Domain, she rightly called out in December 2024 that Brisbane, Adelaide and Perth were going to be the highest markets of growth.
Yeah.
And for 2025, which was rightly so, all those markets saw in housing 9% growth, which is almost double that of Sydney and Melbourne. And more so units really performed.
Yeah.
So Clayfield being close to the city, it's quite a affluent area. It's probably for people that want to reference it to a location of Sydney. It's kind of like the Lower North Shore.
Yeah, it's probably a good one.
Yeah, looking it's kind of like, the around Royal North Shore Hospital there, a lot of medical buildings in the area, bit of a medical precinct. And what we liked about this asset is it's an A-grade medical asset in the sense that it was a newer build, where a lot of the buildings in the area were sort of a older style and didn't have as much parking. So naturally, with sort of tenants chasing better spaces, they chase A-grade buildings, right?
Yeah, refitted, older, almost retail-like assets, some old bank vaults and bank buildings of bank branches, if you remember those, what they can look like. Parking's, you hit on an interesting one there, is parking's key. So access, we see this in our retail spaces. Being able to access quickly into space is, believe it or not, really key. And we've got, secured basement parking for everyone. So
I think it was 70 spaces, wasn't it?
Yeah, that's about right. Yeah. So that was the other thing that attracted us to that.
Especially because we're on one of the main roads there of Brisbane, so just being able to pop off the main road, go underneath to parking, and visit your GP or do whatever you need to in the complex is a big value add, especially for the businesses that the alternative is these older buildings that don't offer that parking.
Yeah,
it makes it very desirable for these businesses. All right. Do you think there was any other call outs about College Junction Medical before we talk about some other?
No, I just think it's a really good example of how we've put together how we look at sectors and make it work and put it all together. And we'd love to be able to do those more times than we that are on offer. But when they do come up, you've just got to be able to act quickly.
Well, actually, two call outs that just came to mind before we move on to my next topic. The below replacement costs purchasing, that's something that we chase. And that's what we did with Wingate. That asset was a replacement value of 121 million, and we purchased that for 86 million. Now, the replacement value is for just the building, so that's it's excluding the land. With College Junction Medical, the land is in a much more desirable location, being the heart of Brisbane. The replacement cost that I read 31.5.
I think that's
replacement value
on the building,
on the building, and then so we've purchased it at 30 million, but the land there is worth significantly more than the other asset that we syndicated in Southport in terms of a per square metre basis. So that's always the goal, especially at the moment with counter-cyclical investing, which we'll get to as a next point.
Yeah, and you can do that in a lot of markets at the moment, which I think that's why real estate's got a good space at the moment, because the cost of supply and competing supply into the future is going to be costly, and that's you're going to benefit either two ways. One, there's no competing supply, so you'll have more attention back onto your asset into the future. Or if supply is being built, it's because ultimately rents are going up, and you should be able to benefit that at the cash flow level. So it does feel like a good space at the moment for those asset classes.
Now, the second thing that came to mind I wanted to discuss was the timeline. It's really important for our listeners and investors to get familiar with how quickly these opportunities move.
Good opportunities.
Good opportunities. So good opportunities, you need to move fast. Fast in your world still takes months, but in our world, when dealing with the consumers or the investors, there's a brief window of registering your interest and committing the capital, because we've made commitments to a vendor that is expecting unconditional contracts, by a certain deadline. So let's talk to that time frame. I believe we raised our bit over $8 million, or collectively the 16, but between us in a 3 to 4 week window. So if you're interested in these assets, you do not want to be in a position where you need to go and borrow money against equity in your home during that period, because trying to borrow money against equity in your home to invest in assets like this might not happen in a 3 to 4 week window. So if you are interested in commercial syndication, get your funds ready to pounce on an opportunity when it arises. And toward the end of this session, we'll talk about an opportunity that we're working on in the near future. But that time frame, start to finish. Why don't you tell us a bit about that, Mark?
Yeah, so we'd always like more time, but I suppose people come to us for these assets because they know we can complete, and we're good for it within a very defined period of time, usually working towards what their needs are. And that was certainly the case here. They wanted the transaction all wrapped up pre-Christmas so they can start the calendar year, fresh.
People coming to you being vendors wanting to sell an asset.
Vendors and their advisors.
They can rely on dealing with Westbridge.
Yeah, correct. So I think once we'd taken a look at that, we can typically do pretty comprehensive due diligence on our side because it's always reliant on other parties giving us information, usually the vendor. So if we can get the free flow of information coming through and we're happy with the quality and we can get the answers that we need, we can sort of do that due diligence, pretty comprehensive due diligence period within 4 to 5 weeks. And in amongst that time, sort of once we've got through a little bit of the due diligence to make sure the key questions are sort of answered, then we're into the capital raising. That's when we had our conversation. That was sort of a three-ish, maybe closing into 4-week period of going from first communications out to investors
and closing
to being able to have that. I think we had a deposit check of about 10% on that time just to make sure everyone was committed.
Getting 10% paid from investors to exchange contracts unconditionally with the purchaser, with the vendor.
Yeah. And so we are, and obviously that's not the first time we have done that. So we've got a good process in place. The key to being able to move in that and getting investors comfortable with being able to move into that is having really good information and being able to respond to requests for from their requests for information very quickly. And so we make sure that we've got great marketing collateral that answers the questions succinctly up at the beginning so people can provide or get a very succinct overview of what's happening. We keep it super simple. And then as investors look to have more information, sometimes beyond the information memorandum, so sometimes they want to see cash flows, they want to understand a little bit more about the strategy. But we've got, I think we did a webinar, we were able to sort of deep dive into our views on the asset and how we were going to execute on the asset management plan, what we liked about it, so they could get an understanding of their thoughts. Because one of the things we didn't mention in any of this, we've talked about how we look at assets, but the big thing, that's going in over this next 5-year period is we're having a relationship with investors and we're the stewards of their capital. So they want to know, I would certainly want to know from my manager how they see things and how they approach situations to get me comfortable that they're going to be a good steward of my wealth over the next 5-year period. And that's key, I think, in any investment coming through. So that's, that marketing period is a really good opportunity for us to be able to build a good relationship with yourselves and our investors as well. So that all comes out from clear, concise communication.
All right. Well, it was definitely a smooth process, a bit different to our last process with previous investors, not because of Wingate doing anything wrong, but more because of the asset itself was the vendor was in receivership.
Yeah, well, there's never a simple transaction when it comes to commercial real estate.
Yeah.
We probably had we had a really good, I think we were buying off a very good vendor which had all the information in place.
Motivated vendor. Yeah. And a reputable vendor in terms of, a readily available information.
Yeah.
Yeah. All right. Now, mindful of time, and there's a couple things I want to cover. We do want to, talk about a next potential opportunity on a high level that might be coming out in the near future to kick off the year. But before we do so, there's a sort of analogy or terminology that you commonly refer to, countercyclical investing, which it's basically the thesis of why we launched Shore Invest 2 years ago, because it was at that record high interest rates that were forecasted to come down. I think it was meant to start coming down in early 2024, but that never happened. And that was that riding that wave of interest rate. The downward wave of interest rates or downward trend of interest rates is the whole, I guess, concept of countercyclical investing, because as rates come down, valuations on commercial assets like this, institutional grade assets, naturally have upward pressure, because the trading price, the measurement of looking at value in these institutional grade assets is the cap rate, which is directly correlated to interest rates. And for people that don't know what the cap rate is, it's basically the passing yield. So, Mark, you would be able to talk to that tune a lot better than I can. So, run me through countercyclical investing and why there is an increased interest in investors chasing syndicates like this at the moment.
Yeah. So maybe swap out the words counter-cyclical, because it sort of sounds like you're always taking the opposite side of the bet all the time, or contrarian investing. Sometimes you pick up in equities. I do prefer the sort of the value-focused mantra. Like, we're always just trying to find good assets comparative to what else is in the market. On pricing that's better than what you can find out comparatively in the market. And I suppose the counterpiece is that it acknowledges that you can't always, like you're giving the example of everyone buying office buildings in a particular sector at a particular time. Very difficult to outperform your peer group when everyone's doing the same thing.
Yeah.
And so back to where we started the conversation is we're out looking at across those 1,000 deals that come through our emails and conversations each year, looking at for where can we pick up good pricing. And that's usually going to come from an area which has probably had a little bit of a capital shock. People that or something that's no longer in fashion. It was retail up to 2020 before. Like, you remember that 2016 to 2020, you couldn't give retail away. Retailers were going out of business. As all of a sudden, if you take a look back for 2025's number, you'll probably see that some of the largest retail trades have occurred last year. Some of the best prices and tightest yields have been into that retail space. So things do come back into fashion. So that's a long-winded way of saying we're just trying to find what's out of favour, work out why it's out of favour, and see if there's a way in which we can add value to that situation.
Well, in the last couple of years, what's been sort of out of flavour, if you say, you could say, is that the fact that institutions and these bigger property funds and groups have not been able to be purchasing assets. So competition's been weak. Because they were caught with a sort of extended amount of debt through COVID, and they went and aggressively bought assets through that COVID period. And then in the last couple of years, throughout 2024 and 25, they weren't buyers anymore; they were sellers. So that produced or created opportunities for good value buying. There was a lot of big funds selling assets for well below what they paid for it. Only a couple of years prior.
So you can look at it across asset classes and then across geographies. Is probably the easiest way to look at it.
Yeah.
So we've talked quite a bit about the medical and sort of our views on that. The other way, though, if I throw a geographic lens over it, you've seen as the market's changed, and also how governments have reacted to filling up deficits. Look at Melbourne, additional stamp duty or land taxes. So that's sort of also created opportunities in the marketplace. So you've started to see institutional interest sort of really concentrate around Sydney and a little bit of Brisbane in the various asset classes, leaving sort of Melbourne. So Melbourne's looking, comparatively soft. Now it's soft for a reason, but the question is, can you solve those issues around that side of things? People have also started to leave the sort of what people sort of called secondary markets, sort of like Adelaide and Perth. But if you look at an industrial sense, and even in some of the other sectors, they are some of the lowest vacancy markets in the country, with some of the and with almost negligible future supply, which should give you the benefit of being able to, for the right assets, above average yields, because there's less people wanting to go into that space. And conversely, you're seeing pricing in Sydney for a lot of those assets sort of holding, because everyone wants to go back to the crown jewels of real estate, which is usually around Sydney. So that's where we're starting to see the next sort of line of opportunities coming through.
And I have to call out on the comments of interest rates and, I guess, betting against the tide. That landscape has changed this year with last year's inflation data and that tail end of last year. And now all eyes are on, the inflation data that's going to come out at the end of this month, the quarterly inflation, which is basically going to dictate what we do next month at the February RBA meeting. And if we have an upward, if there's any upward pressure, or if there's an increase in interest rates, it's going to make investors a little less confident probably in the commercial landscape, but at the same time, it might actually promote or create more opportunities.
Yeah, absolutely. And we're always trying to making sure that we've got a big enough, back as a value investor, a big enough spread in what we're buying to accommodate both an increase in any eventuality. Now, whether we're capturing it, ideally you want it in the price, so the front end yield, so you want a bigger yield to be able to compensate you for that risk. But the other element is, can you grow that rental income, or there are other things that you can do to the asset to improve it? Maybe it's extend it, put additional floors that we were talking about before, or extend onto the side of a logistics facility that allow you to grow income at a faster rate than what the impact of an increasing base rate may do to both your cap rate and also to your borrowing costs.
And I guess to endorse that conservative approach, that you don't factor in interest rate cuts, to your underwrite as such, both in the $30 million acquisition last year with Clayfield and the $86 million acquisition the year prior with Wingate, in the IM, the information memorandum given to investors for both those investment opportunities, there were no interest rate reductions factored into the IM or the cash flow model in that IM, meaning that any rate cuts was just going to be an added bonus.
Yeah.
Now, last year, you could say the tail end of last year, that was, that's not being too conservative. That was kind of expected. But the year prior for us with Wingate, it was expected, right? So naturally, being an ASIC regulated investment product under an AFSL, which we both know comes with a lot of scrutiny, you always got to be conservative in your approach with your forecasts, and don't put these opportunities of rate cuts into your underwrite.
Yep, we're always trying to bake all that in. We want as much protection up front as possible.
Yeah,
or at least have the levers to allow us to navigate that, the options to be able to navigate that into the future.
So I guess we're running out of time here now, Mark. We could talk all day together, but lastly, a bit of a teaser. So let's give a bit of a high level summary on this new asset that we're hoping to potentially release to our clients this month. Yes, yeah. I'm saying hoping because I'm careful what we say, but on a high level, so for Shore Invest clients, we did our retail centre in 2024, we did our medical centre in 2025, and now we want to diversify in an asset that Westbridge are looking at being industrial. What can you talk to us? What can you say about that?
Yeah, so we still like the industrial sector. We still think in various markets it's not getting the same explosive growth. It's probably getting a more sustained level of growth. And within the smaller end of the market, which is what we like to focus on, so not the really big box that sit on the perimeters, but on the infill locations, there's still consistent demand.
And the explosive growth you're referring to is the sector historically, I should call out.
Historically.
Yeah, it's not the explosive growth you're talking about the other sectors.
No, that's right.
Yeah.
And so we still like the dynamics. We've been focusing on, as I think I was alluding to earlier, markets that have got the tightest vacancy rates, and also where's the least supply and where is demand being consistent, because that's going to be the dynamics for a demand outstripping supply, which is going to help you in growing growth, again, in your growth case. And so we've been, one market that we've looked at recently has been Adelaide. We quite like the Adelaide market. We're focused on the infill area around the ports. There have been a couple of other people that have moved into there. We're looking at a smaller play, well-connected locations, good in-place income, but again, with levers that you can look to drive growth. So big sites, low site coverage ratio, which means you've got a big site with a small building on it, which allows you to either expand or cut parts of it off to be able to return capital to investors or to utilise that capital to improve other parts of the asset.
So after I did some research on that area, Port of Adelaide, post our conversation of this particular asset, I did, just to your point about vacancy rates, I think it's one of the most tight areas in terms of low vacancy in Australia for industrial. I think it's the second.
Second, I think Perth is the lowest and Adelaide's the second lowest. And I don't think I've got this wrong, but I think those two markets are also the lowest vacancy rates in Asia Pacific. That was covered by a number of the real estate agents that have got that cover those markets. So that gives us, a bit of confidence.
Now, naturally, we don't put added bonuses, like I said, of the extra floor space in College Junction, or decreases of interest rates in the underwrite. However, a big obvious one for the Port of Adelaide is the potential for this AUKUS deal to go ahead.
Yeah, exactly right.
I did, as much as you can't rely on ChatGPT for investment advice, I did ask ChatGPT the percentage chance, the likelihood of that coming off, and it gave me, I think, an 85% chance of it going ahead.
I hope it gave you a big disclaimer after that.
Yeah. We would have to do the disclaimers. This is general advice. That's our disclaimer. But that would naturally put a lot of demand on those industrial assets in that area.
Yeah, that would change supply chains and how things need to supply. And look, we're not even that's a nice thing to have. And I think realistically, I think from what I'm reading in the headlines, so that's all been happening at the sort of back end of December. There's been some very positive conversations. Exactly what that means for submarine building in Adelaide, I suspect it's going to be some time off, but that's always going to be a positive memento part that will keep the market quite buoyant, which is kind of what we like. In that intervening period, which is between now and whatever may happen, you're still sitting on the tightest vacancy rate. You're still building ships down there, and there's a very, very buoyant small market, user market, which is sort of, we say small being is in sort of occupants sort of about 3,000 to 4,000 square metres and below, that have still, which is, what Adelaide's always been great for, is they still manufacture in various shapes down there, and there's still great demand for industrial and logistics facilities there in the well-connected locations.
Well, I'm dubious that we can't share too much, because at this present time, we're still working through the asset itself. So hopefully by the time that this podcast is released, it will be closely followed by a register your interest email to jump on board the investment. But Mark, unfortunately, we have run out of time.
Too much talking.
But thank you so much for joining us today. Hopefully this is the start of many more podcasts we do together. We have a lot of repeat guests, so you might be one of our new celebrity appearances that come back on an ongoing basis.
I hope I can keep the standard.
Yeah. Just maybe need to not sound so smart and sophisticated to our investors, so that
You're the first person that's told me.
We could take ourselves out from the world of asset managers. All right. Well, thank you so much for your time, Mark.
And thanks for having me.
And thank you once again to all our listeners today. Make sure you like and subscribe to wherever you listen to your podcasts. This business is built on word of mouth, so please refer us to all your friends and family. They just want to say tune to the latest property and finance tips. Thanks again. Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast.